Hey, this is John. Today I just want to talk about the new sovereign wealth fund in Canada that's coming up, the Canada Strong Fund, and just kind of give some quick thoughts on the matter. I know it's very early, but maybe it's characteristic of the news to yap about every single thing that comes up, even before we have any of the real details. So today I will be partaking in that tradition. And if you like this video, please like and subscribe. Quickly, I'm just referencing a book at the beginning of every video to help promote literacy in North America. So this week I'm going to talk very quickly about famine, affluence, and morality. Basically a collection of essays from Peter Singer, who is a very influential ethicist. And I do find some of his arguments very compelling. I think that this book is very relevant to the modern day, what with everyone kind of growing up with only sort of, too much emphasis on economics, frankly, and not enough on morality. Okay, anyways. So what is the Canada Strong Fund all about? Well, basically, from what we know, this is going to be a sovereign wealth fund that individual Canadians can invest in, and it's going primarily towards infrastructure projects. So there are a few distinctions from historically what has been the case from what I gather. So let's kind of talk about that. So first is the use of debt financing from the government. That seems to be the main way that they're likely to fund this. I mean, there has been some suggestion that they might sell off some of our public assets like airports, but I don't think that we should necessarily take that seriously at the moment. I think most of it is going to be probably what they've suggested, which is, debt financing, right? Now, this is new for sovereign wealth funds, not necessarily new for the government itself. I do think that there has been an overemphasis in economics, generally speaking, for a lot of the public commentators to refer to historical precedents, which is typically fine. That's usually going to give you the right answer, but history can only ever really give you clues, not answers. So I think that when we say, okay, or when we're trying to answer a question, is it necessarily a problem that they're using debt financing? I think really we have to, rely more on market philosophy, if you will, especially in the current regime, which is constantly changing, rather than just historical precedents. But it is true, yes. I mean, the Norway funds, for example, don't use debt; they use government revenues. But is it necessarily a problem that we're using debt? Well, no, and there's a few reasons for that. The first, and I've commented on this before, but the deficit basically just isn't really that important. And the main reason for that is most of that money is just owed back to the citizens. The deficit is primarily a concern when it is owed to foreign investors, and then they can quickly pull money out of our market, right? That can be a problem. Additionally, we might just not really have other funding options. So, for example, usually you'd use revenues, right, to fund these things. But if Canada doesn't have revenues, then you basically have one of two ways to deal with that. Supposing that you wanted to resolve a deficit, or suppose you were running a company, for example, and you were not profitable. There's pretty much one of two ways that you can resolve that issue. One is to cut costs, the other is to increase your revenues. But the thing is that you're not going to increase your revenues if you don't spend money. Almost always the case. In the case of the government here, it's basically inevitable, right? So the only way then for them to increase revenues, which is probably preferable anyways, just cutting costs to, so to speak, increase profits in a company, especially given that the government just doesn't work that way. I'm using that as an example. Is to increase revenues. That's much preferable, right? So, in other words, what I'm trying to say is, if your country's in a slump, you do have to spend more money. Capital injections are basically the only way out of that, like it or not. That's sort of just economic reality, right? Now, regarding the use of debt, the main issue is going to be inflation, as I note here. And I think I've said this in the past, but the principle for how to think of inflation is not necessarily inflation is bad, although we've certainly seen a lot of people yap about that over the last few years. Inflation is sometimes bad, and sometimes it's like kind of neutral because it's accompanied with other effects, right? So, for example, the way that economic cycles work are more or less related to the central bank's interest rates. And so the idea is that when the central bank lowers the interest rate, you have cheaper capital out in the market, more companies take on more debt, there's more money circulating. And so there's obviously more inflation there, right? The loans create money, and that, increases the supply of money, reduces the demand for your dollar, reduces its price. But the idea, though, is that with the additional money circulating in the market, there's increased economic growth, and that's at least, the historical precedent has been that the benefits typically outweigh the issues of increased inflation via economic growth. Now, obviously, that sort of regime has been changing over time, and will that be a good thing? Well, maybe not. It depends on how regulations kind of unfold regarding the corporate squeezing of people. So, yeah. Okay, but again, in principle, not necessarily a problem. But yeah, the economic regime is changing. It's changed. It's still changing. Yeah. Now, okay, and I already said that. Okay, cool. So again, just in principle, we probably just have to spend more money, to be honest. Okay, now the focus on infrastructure. So this is kind of interesting because it is coupled with the idea that individual investors can invest in the fund directly. So just kind of make this a simple discussion, I guess. The most important decision that you're going to make in an investment is, I guess the most important part of an investment decision is the asset class you invest in. That's not to say that other things can't move the needle, obviously, but it's kind of like, I guess, deciding, are you going to wear shoes or boots, and then picking between those shoes and boots. The biggest decision is obviously whether you're wearing shoes or boots, right? So same thing here, right? I can, select, say, equities, and then I can choose the companies in them. But the most important decision is that I'm investing in equities, for example, as opposed to, say, fixed income. So when I say that, with infrastructure investments sort of being in the alternative asset classes, and then, probably coupled with similar characteristics to, say, like long-term private assets, the main issue here is that you usually have, if you're going to have investors investors invest directly, is you usually want investors to have certain restrictions, a level of sophistication, maybe a certain asset value to put in. And why is that? Well, when you put your money into, say, a company, it's usually considered a going concern. It's not such an issue. Say, you pull out your money and you sell it back, sell your stock back into the market, right? Whereas if it's in an ongoing infrastructure project, say, like the building of an airport, for example, or, I think in this case, they're referencing things like mining projects, right? Well, if the project comes short on, say, certain expenses for some reason, then that could destroy the entire project for everyone that's kind of invested, right? That can't happen. Probably won't happen for you, but that can happen. So what you usually get is, some combination of those things. A common thing, for example, in say like private equity is gating mechanisms. So you basically have restrictions on when you can and cannot pull your money out, how much notice is necessary, and so on. And that's to kind of protect the entire fund. So what's probably going to happen here then is going to be probably something like an ETF or some other pooled fund type, right? Now, the only problem with that for sort of the individual investor is that you are usually going to inherit the same characteristics of, say, that asset class that you're maybe trying to avoid or differentiate from. So, for example, fixed income ETFs still perform pretty similarly or have, closer, a more similar profile of characteristics to equity ETFs than you would expect. And why is that? Because they're still in the same sort of market. Okay. And actually, one thing to add as well to the sort of debt financing idea as well is that, again, I think that the main idea of the fund is to try to make as much money as possible. One, alternative assets are the way to do that. Though, again, I'm going to greatly simplify the discussion, right? I mean, different asset classes come with different risk return characteristics and so on. And usually what we see, just on principle, is that the more volatility, that's the traditional measure of risk, volatility, the more volatility in an investment, the higher the returns. So that's usually what we see, right? So, and vice versa. So anyways, that's also to suggest that alternative assets can be very volatile, which, coupled with that, may not be such a good idea depending on exactly what the covenants are and other things that might govern the arrangement. But to add to the discussion of debt, though, debt is also used to leverage your returns. So if you couple that with alternatives, then yeah, you can sometimes expect pretty high percentage returns relative to what you had initially invested of your own capital. Okay. Now, okay, so I think that's for that. Now, one thing to mention, because even if you don't end up necessarily differentiating from, say, the other types of investments that you can make, it would still be beneficial to, say, your own economy. We're here in Canada talking about this. To put money back into your own economy. So if that's something that interests you, seeing your own country flourish, that's maybe one reason to invest in this fund or in other, Canadian native assets. Yeah. Now, a couple of things. I'll actually address maybe the last one first, just because there have been other kinds of ideas kind of floating around here. One quick thing to mention is that in the discussions of, say, in this case, like ethical concerns surrounding the fund regarding, power concentration, basically, there are two separate uses of the terms public and private that, everyone should be aware of. The first is referring to government and entrepreneurial, and that's, I think, traditionally what people mean, and that's usually the kinds of language that ethicists use, right? I don't know if those are necessarily the people that deal with the market issues, but it's probably an ethical issue. Blah blah blah. Okay, so the public and private markets, right? But then there's also another set of public and private markets or public and private investments, and that's referring to listed and unlisted assets. So listed being assets that anyone can invest in, and unlisted being assets that are harder to invest in, if not impossible for you. So that's one thing to keep in mind, just because that may clarify some of the other discussions around the issue. Okay, and then last, is this putting too much power into the private sector? So I think that that's too early to say, but my answer to that is that if there are public assets that are, significant to public interest that have to get sold off to fund it, the answer is probably yes. So, for example, the suggestion of the public airports getting sold off. And I've traditionally been against that anyways, for at least two reasons. I mean, first is that although you have these sort of like bootlickers talking about Adam Smith a lot these days and how he's more right than Keynes, even though he didn't really understand economics that well, and it was kind of the sort of birth of economics around that time. In addition to Adam Smith being apparently constantly misinterpreted, which is hilarious. But Keynes did, for example, believe that there does have to be some kind of counteractive government force in the markets, and I'm generally of that mind as well. One of the reasons for that is to not let bad things happen, like the occurrence of monopolies, which then do, more or less exercise their ability to take advantage of consumers, right? Okay. Now, probably not. So, is this putting too much power in the private sector? Well, probably not, though, if it, exercises if it functions like a normal wealth fund or a normal investment. At the very least, that wouldn't concentrate, the money in the private sector any more than other types of investments. And a lot of these people, I think, are, who are commenting on it like that, are attributing the issues of neoliberalism to this wealth fund, because that's just kind of like generally how investments work. So, regarding like that, yeah, I don't think it, concentrates anymore, provided they aren't selling off public assets. Those aren't questions that we know the answers to today. So, yeah. So, anyways, I hope this commentary was kind of insightful. I think generally this is probably a good thing, and the main point to take away from all this is that, the only way that you can really, my belief is that the government does have to spend more money if they want to increase revenues, and I do think that increasing revenues in the case of a, more or less when you're kind of on the verge, at least, of a economic crisis, is the optimal way to deal with things. So, okay, cool, bye.